Preference shares are frequently used in venture financing to give different economic and governance rights to some investors, especially relative to the ordinary shareholders. Generally, the preference shares will enjoy preferential treatment to the ordinary shares if the company is liquidated, and they'll be first in line for any dividend distributions. Frequently, these preference shares also enjoy limited or no voting rights, and they are issued to allow a company to raise long-term capital, but to reduce the risk to the investor relative to a pure equity play or an investment in the ordinary shares. Similarly, in some transactions, convertible debt may be used. In principle, convertible debt is simply debt that can convert into equity on pre-agreed terms and conditions. Often a company will raise convertible debt to begin building its first product and before a Series A fundraising. Investors and providers of debt capital are aware they're investing at one of the riskiest stages of the company's life cycle, and they use convertible debt as a means to be in front of the queue if the company is liquidated before the ordinary and the preference shareholders. Because of this, most convertible debt will either be capped or have a conversion discount, or sometimes a combination of both these features. Let me explain. Cap notes set a ceiling on the maximum price at which the debt will convert to equity when a Series A capital raise is done. For example, with a convertible note of 5 million, if it's converted into equity, the holder can receive a maximum of $5 million worth of shares. If the Series A valuation round is lower than expected, then the debt holder may get, for example, 4 million worth of shares on conversion as a result of the lower valuation. If the Series A valuation round comes in higher than anticipated at, say, 10 million, then the debt holder will convert to equity, but this is capped at 5 million worth of shares. The effect of the cap in this example is that the debt holder will effectively receive 50% less shares from the conversion than a Series A investor injecting 10 million into the company. The second feature is a conversion discount. This basically means that convertible debt can convert into equity at a discount to what the Series A investors have paid. So again, for example, with a convertible note of 5 million, the debt holder will be able to convert into 5 million worth of equity. However, because they enjoy a 10% discount, this would translate into 5.5 million worth of equity that would be received. So convertible debt is sometimes preferred by entrepreneurs at the seed stage of financing because it costs less and it's simpler than raising equity. The standard convertible debt instruments are pretty simple and they don't require as much legal time and as expense. Convertible debt also allows the negotiation of a valuation to be deferred to a later stage to some extent. A mistake that's made often by entrepreneurs is to raise too much convertible debt in the early days of the company. The end result of this is they give up much more equity up front than they had originally intended. So for example, let's say you're a founder and you own 70 shares out of a total of 100 shares that have been issued by your company. Effectively, you own 70% of the company, and let's say the remaining 30% is owned by the employees. If there's outstanding convertible debt and it converts into 20 additional shares for the debt holders, this is how the ownership structure will change. As the founder, you will still own 70 shares, but now there are 120 shares in issue. That means your 70% ownership will have been diluted to 58%. And the share ownership of your employees will have dropped from 30% to 25%. So as an entrepreneur, be mindful of this constant trade-off between raising the capital you need to grow your business and minimizing the dilution to yourself and to your employees.